The global financial landscape is undergoing a shift that most investors are barely noticing. While headlines focus on interest rates, inflation, or stock market highs and lows, a more subtle change is quietly reshaping markets worldwide. This shift is not about a single event. It's about a transformation in how capital flows, how central banks operate, and how investors are adapting to a rapidly changing economic environment. Understanding it could mean the difference between being caught off guard and positioning yourself to benefit. For decades, the financial world has operated on predictable cycles. Stocks rose, bonds fell, and investors followed familiar patterns. But the recent combination of geopolitical tensions, rising debt levels, and unprecedented monetary policies is challenging these traditional assumptions. Investors who rely on old rules may find themselves on shaky ground as this new paradigm takes hold. One of the most critical aspects of this shift is the changing role of central banks. Institutions like the Federal Reserve, the European Central Bank, and the Bank of Japan are no longer just responding to economic conditions, they are actively shaping them. Interest rate decisions, balance sheet expansions, and liquidity interventions are creating ripple effects across markets that traditional models struggle to explain. For investors, this means strategies that worked in the past may not yield the same results today. Another overlooked factor is the migration of capital into alternative assets. From private equity to real estate, commodities, and even digital assets, money is moving in ways that challenge conventional wisdom. These flows are not only influencing asset prices, but also altering market volatility, correlations, and risk dynamics. Savvy investors are watching these shifts closely, identifying opportunities before they become mainstream. Global supply chain disruptions and technological advancements are also playing a role. Companies that can adapt to these changes are attracting more investment, while those tied to outdated models are seeing capital exit quickly. This creates winners and losers, not just in individual sectors, but across entire economies. Understanding which industries are likely to benefit from these structural changes is essential for building a resilient portfolio. Meanwhile, emerging markets are experiencing a quiet renaissance. While developed markets deal with high valuations and slowing growth, many emerging economies are benefiting from demographic trends, technological adoption, and growing consumer bases. Investors who recognize these opportunities now could be positioned to capture outsized returns in the years ahead. Currency markets are also reacting to this shift. As central banks adjust their policies, exchange rates are becoming more volatile, creating both risks and opportunities for global investors. Hedging strategies and international diversification are no longer optional. They're critical for protecting capital in an increasingly interconnected world. Environmental, social, and governance factors are subtly reshaping investor behavior as well. Capital is flowing toward companies that demonstrate sustainability, ethical practices, and social responsibility. This trend is no longer niche. It's influencing valuations, investment decisions, and corporate strategies on a global scale. Ignoring this factor could mean missing a significant part of the market shift. Technological innovation in finance itself is accelerating the transformation. Artificial intelligence, algorithmic trading, and blockchain solutions are changing the speed and efficiency with which capital moves. Investors who understand and leverage these tools have an edge, while those relying solely on traditional methods risk falling behind. The shift also affects risk management. Traditional metrics for assessing market exposure, portfolio diversification, and financial stability may no longer apply. Investors must rethink their approach to risk, considering factors like geopolitical shocks, cyber threats, and climate-related risks that could impact markets in unexpected ways. Behavioral changes among institutional investors are another hidden force. Large funds are increasingly focusing on strategic allocations rather than short-term gains, influencing market trends quietly but powerfully. Observing these movements can provide insights into where smart money is flowing before it shows up in headline indexes. Debt dynamics are also a key component. Sovereign, corporate, and consumer debt levels have reached historic highs, and managing these obligations is influencing policy decisions worldwide. The interplay between debt sustainability and growth expectations is creating both opportunities and constraints that are invisible to casual market observers. Interest rate environments are evolving in unexpected ways. While many anticipate a return to historical norms, central banks may maintain unconventional policies for longer than expected. This has profound implications for fixed income, equities, and even real assets, forcing investors to rethink their assumptions about returns and risk. Finally, the psychological aspect cannot be ignored. Market sentiment, fear, and optimism are being influenced by global events in real time, amplified by social media, 24/7 news cycles, and algorithm-driven platforms. Emotional reactions can exaggerate market moves, creating both hazards and opportunities for disciplined investors. In summary, the shift no one is talking about is subtle, complex, and pervasive. It affects capital flows, risk dynamics, technology adoption, and investor behavior on a global scale. Those who recognize these trends early, adapt their strategies, and remain flexible stand to gain, while those who cling to outdated models may find themselves on the wrong side of history. Staying informed, vigilant, and proactive is no longer optional. It's essential in today's transformed financial landscape.